Hello, I wanted to give everybody a message, kind of what we're looking at with all this coronavirus in the news and how the markets are doing, and just kind of an update on some of our thoughts and what we're planning on doing about it. First thing is, these things are never any fun to go through. Markets are volatile, stock markets are. One of the statistics I share with people is in the last 100 years, only 1 out of 6 years does the market, the S&P 500, end up with a gain between 1% and 11%. So almost always it's either more than 11 or it loses money. So half the time it does better than 11, but a full third of the time, 2/6 of the time, it does one or loses money. So it's very disappointing a third of the time, really happy half the time, but only 1 out of 6 does it end up where you think it should. So it's very volatile. We don't know today what the outcome of this virus is. I do have a little historical perspective, not to say it'll be the same on this or not. I do know that 12 months after the following, we had these returns in the market. So when SARS came out, 12 months later, the market was up 21%. The avian bird flu, 18%. Swine flu, 36%. Ebola, 10%. Zika flu, 17%. So there was all of those. We were able to get through just fine. Again, I'm not going to prognosticate on this one as it relates to those. Other things do take longer, like 9/11 took probably 3 years. And then obviously the Great Recession of 2008 was really not fun to go through either. So we're looking at this and saying, all right, we don't know where it's going to be. The valuations of the market just prior to this, the market was just slightly overvalued, but not too bad. We had a lot of good things happening. I mean, everything that could go well for a market was set to go well. We had low interest rate, historical low interest rates. We have the biggest middle class ever with the emerging markets. We have low income taxes, lower regulations. We have technological advances that are doing all kinds of good things for all different industries. So the world economy is humming along and doing just great and set to do really well. There's only one thing I thought could get in the way with that, and that would be maybe an election that you had people that were not pro-business in the office. But that was the only one I was thinking of. I didn't know about coronavirus. So here we are with that. Big picture, of course, we'll get through this. Markets will they recover. They have 100% of the time from everything that's gone bad in the world. They just do. We'll get through it. But in the meantime, we're not sure the short-term volatility. And so even with those recovery numbers, the stuff that I'm seeing and reading saying, gee, it's going to have a massive effect on corporate profits. Now, a little over a year ago, December of 2018, there was a massive drop in the market similar to this one. And it kind of happened overnight like this one did. And I decided not to react to it. I'm glad I didn't, because it took about a month and the thing recovered. And the reason we didn't react to it is because there wasn't any particular reason for it to do it. It was just selling begot selling, and people panicked because market was dropping, and that often happens. And it gets oversold, and then smart money comes in and buys. This one feels a little bit different. And so, again, I don't think it's going to be very long term, but in the short term, who knows? And so kind of taking the position, I usually like to not react or time the market at all, but taking the position, maybe some reaction, some insurance policy makes sense. So what we're planning on doing is we're going to sell a few positions, not an incredible amount. Depending on your portfolio, it'd be 15 to 25% of the positions. And we're going to instead replace that with something called an inverse fund. So what an inverse fund is it does essentially the exact opposite of the market. So if the S&P 500 was down 10% over a period of time, the inverse fund should be up 10%. The inverse is true. If the S&P was up 10, the inverse would be down 10. So inverses have not had a good run because markets have done pretty well over the last 10 years. But it's a way to, if we have drops in the market, not only have we taken a percentage of your money out of the market for now, but we've also replaced it with something that would actually gain money, gain value if the market loses. Kind of a weird concept. It's called shorting the market. And so we'll have the effect of that, so that we're going to mute both the downside risk and the upside return potential for the time being for a percentage of the portfolios. So that's kind of what we're planning on doing. We're trying to get those trades in as soon as we can to accomplish that. We're not bailing on the market. I still think the market's going to be really good, and it's going to be a real buying opportunity at some point. And that's the other hope, is that with the money that we have outside of we call them long position on the markets, but short, that it's one thing to sell, which is, or actually buy the position. The other timing thing will be when to sell it. And so we're going to do our best to try and figure out when we think is a good time to get back in long. This is a good opportunity to reflect on the portfolios and how they've been structured. As I look at the results of the S&P 500 for the last year, as of today, it's up about 6.7%, and about the same for 2 years, because we had that December crash a year ago December. So it hasn't had a great return because of the recent volatility overall during that period. As I look at, say, a Fidelity balanced fund, or a basic blended fund that has a little bit of everything: stocks, bonds, U.S. foreign, large cap, mid cap, small cap, the 1 year return is about 3.5%. The 2 year return is almost nil, nothing. And so a blended return really hasn't returned anything in 2 years. However, for most of the clients of Madrona Financial, we have spent a lot of time talking about alternatives to the market. And so the goal was that when we have a situation like that, I'm sure a lot of you have heard me say this, I want the drop to be annoying and not life-changing. And how we make it not life-changing is making sure we have alternatives to the stock market. So some of those alternatives we've used, of course, are the fixed index annuities. Nobody has lost a dime in a fixed index annuity. They can't go down in value from year to year. Certainly the opportunity to make more money decreased, but you can't lose money in fixed index annuity. So if you're listening to this and saying, I can't take it anymore, I really want more downside protection in my portfolio, please let us know, and we can review it and talk about how a fixed index annuity might be able to help you. My favorite one for growth right now gives you a percentage of the S&P 500 when it's up, and 0 when it's down over the course of a year. It's a 6-year annuity, and it's got 10% free withdrawals each year, and there's no fees at all with that annuity. And so that can be a safe place to participate in the market when it recovers, but never take any losses when it's down. So that could be a solution. A lot of our clients have fixed index annuities in their portfolio, so feel pretty good about that given what's happened lately in the markets. Another area that has done well, we call it a non-correlated asset. That would be real estate, REITs. No investment that has significant return potential is risk-free. So we have a number of REITs that we've used. There's other ones we have come on board fairly recently. A lot of my clients have a very diversified REIT in their portfolio. There's one that's been doing pretty well that we've been watching, $50,000 minimum, but it owns about 7,500 rental houses in the Midwest. They're averaging about $77,000 a house, and they're renting out for over $1,000, or roughly $1,000 a month. And that's been doing really well in combination with other REITs. And so we can diversify those, because sometimes some REITs have hiccups too, just like any investment, like the market does too. But by allocating to these alternative asset classes, whether they're zero risk assets or they're not correlated to the returns of the market, and having some diversity even within our market assets, we've been able to I think most of you should look at your statements. You're still doing pretty well relative to any typical asset allocation fund because of these other strategies. And again, with the annuities, once they go up, they lock in. You never give it back. And so that's a really good outcome for a lot of folks. But if you don't feel like your mix is quite right, just let us know, and we certainly can talk about some of these alternatives to the market. But we are making those. We'll be making those steps. Poor Carolyn is working feverishly to try and get these trades in. It's very difficult to do that many trades at once, but she's working to get out of certain positions in the portfolio. There's 4 of them for some of you and 2 for others, and then replace it with the inverse to again mute the effects if we have a down market. I'll look back at this and say, hey, that was pretty smart, Brian. I'm glad we did that. If it goes up from this point on, forgive me. We're doing the best we can with the information we have at the time, but that's kind of the call we're making. If you're in disagreement with any of this in your portfolio, let us know, and we'll certainly not pull the trigger like that. But just want to let you know we're trying to pay attention to this stuff, but it's the unknown, and again, I suspect we'll get through this just fine in the end. I feel terrible for the people affected by that. My son's school was closed down today for it. So it's real, but hopefully it won't devastate finances globally or anything like that. We just don't know what the outcome is going to be, but there is a lot of negative press right now, and certainly a lot of people are reacting to that and just saying, whether it's right or wrong, it just is. So we should maybe react accordingly for a while. But I'm going to keep on top of this, and definitely going to get back into the market at some point. Don't know exactly what will trigger that yet, but we'll keep you posted on that. Thank you for listening, and let us know if you have any questions.